So you've got a business, but what about a brand? The difference? More of you. Wix gives you the freedom to create your website, own your brand, and do it on your own, exactly how you envisioned it. Experience limitless customization. Boost your creativity and efficiency with AI tools for every part of your business journey. Scale up with built-in SEO, e-com, and scheduling features. Put more of you in your business. Go to Wix.com and do it all yourself.
This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled this week to pass 7 million downloads and be ranked one of the top podcasts, I think number 1 or 2 in the Apple Business News category. So God bless all of you that listen to the Becker Private Equity and Business Podcast. We're thrilled today to be joined by Matt Wolf. Matt is a brilliant analyst, thought leader in the sort of healthcare private equity space. Brilliant person, one of our most listened to guests. Matt, take a moment to introduce yourself, and then maybe we could talk about what trends you're watching in private equity currently.
Yeah, thanks, Scott. So, Matt Wolf, I'm a director at Elliott Davis. I've spent my career in healthcare valuation and private equity, working on private equity-backed healthcare companies really through the life cycle. And over the past decade or so, I've really focused on the analyst side of that as well, and studying the market, putting together our content, and talking about it to really anybody who will listen to me. So I'm always excited to be on the show and talk about that. And, I guess with the wrap up of April, we were just looking through some of the year to date numbers in terms of overall deal flow, not just healthcare, but private equity deal flow in general. And, despite the excitement leading into the year, year to date, we're down, depending on how you want to measure it, 25 to 35% over the past few years, just an overall private equity backed deal volume. We're now also kind of in the middle of conference season, so I've been talking to a lot of sponsors just about what they're seeing and what they're trying to do. And everybody wants to get deals done. They want to deploy capital. They want to exit long in the tooth companies, but the timing may not be right still, and we're looking for the right deals. The due diligence cycles are longer. The macroeconomic uncertainty, the policy uncertainty continues to dampen some deal activity, not all. One interesting data point, though, is in terms of IPO announcements, just the number of announcements are actually up year to date over the past couple of years, which is a good sign, I think. At least in terms of the number of announcements, not necessarily the total market cap trying to go public, but at least the number of companies going public those announced IPOs is higher than it's been the past couple of years, year to date, which I think is strong, right? We want strong capital markets. It's an important part of the overall economy, even in the real economy, right? Access to capital. And so there's some bright spots there too. It's just, this policy uncertainty will create challenges for management teams, for sponsors, investors, and we're all kind of navigating it together.
No, and your point is so well taken in the IPO market, because that's important, quite frankly, because it leads to a spot where it's another exit opportunity for companies in different ways. Granted, often larger companies, but some of those are not huge IPOs either, and it provides another off-ramp to at least part of an investment and a partly a liquidity event, and at least the potential for one going forward. And I think that is fascinating to watch too. And so that's good news. And as the stock market rebounds, hopefully as debt costs sort of start to normalize and see a little more certainty as trade deals start to get announced, that the markets do become a little bit easier to navigate between buy and sell. I mean, the word I've heard so often recently is pause, that people were gearing up for deals, and then there was a pause in the markets. And so we'll see if that's a pause or if that becomes, elongated.
Yeah, absolutely. And the factors that I continue to watch are in terms of this pause. It's really twofold. One is just the vintage of investments that are out there, right? So, for example, healthcare service companies, so providers, physician groups, things like that are private equity backed. we're approaching 60% of the PE-backed ones have been held for 5 or more years by their primary sponsor, right? Those need to get turned over. That will push deal activity. And then we also look at dry powder and middle market buyout funds, and this is again more healthcare specific, but it's around $250 billion of dry powder for funds that say they invest in healthcare. And there's overlap because some funds will invest across multiple sectors, but that's an incredible amount of dry powder, a very aging portfolio that needs to turn over, and that will continue to push to get deals done. And I think we're still working through this cycle of moving from an era where investors were rewarding growth at all costs into now this new environment where investors want sustainable cash flows, they want margin, they want financial sustainability. And for companies that have that financial sustainability story, they will have access to capital markets. They will have interest in deals, and we will see those deals happen. And looking through the IPOs that have been announced, we see that. That's a consistent theme in the stories. Whereas even 2 years ago, you're still getting a lot of, well, we need to go public so that we can get capital to scale up and be profitable. That's not the story anymore. So yes, definitely a pause, and the sort of duration of that pause is going to look different for different segments of the real economy, different industries, different sizes of companies. But there are some underlying macroeconomic, some underlying capital market factors that will continue to drive deal volume, right? It's not going to be, like
But
the absolute craziness of 2021, but it's not going to go to zero either.
no, but one of the points you made is such an important point. So many of these older vintage deals might be provider services deals. And that's of concern. And here's why. The world around aggregating provider services over that 6 to 8 year period has changed dramatically. So even as the capital markets open up and change, some of those businesses, depending on specialty, are in a much more challenging spot in terms of sustainable cash flow and growth than they were at some point. So you look at things like certain types of platforms built around obstetrics, for example, OB/GYN, or provider services or practice management, that at one point there was a relatively rosy forecast for. Now, between reimbursement challenges, shortage of doctors, still inflationary cost, the cash flow in those businesses is much tougher than it was expected to be 3 to 5 years later. And whenever things get held for a much longer vintage than anticipated, the core thesis around the original investment often can change. And so that's a whole nother set of circumstances that causes some concern depending on how those companies performed compared to core thesis, because over a longer period of time, those core theses either play out or factors change. And we're seeing a lot of that, I think.
Absolutely. And it's such a good point that you bring up, Scott, whether it's, professional services in general, whether it's physician practices or other, accounting firms, whatever, where you had these PE deals back when money was less expensive that were essentially financially engineered to provide the owner operators of those businesses to, really make the same or more monthly annual income that they were making, plus get paid out for their capital as part of the acquisition. And now in this higher interest rate, positive real interest rate environment, that's just not financially sustainable, right? If you're a business owner and if you get a check for your ownership interest in that business, then really economically your distributions from that business should also come down a commensurate amount. But that wasn't what happened with many deals in any sort of professional services setting prior to 2022, right? And so that sort of shakeout, and you said it well, right? The investment thesis has changed, and there's a lot of investors that are kind of frankly holding the bag, and not all of them certainly, but there are some that are in some real tough positions that are going to have to exit at unfavorable multiples, unfavorable cash on cash returns, and that's going to have to work itself through the system, particularly in any sort of owner operator professional services model.
No, 100%. I think that's a fascinating additional take that whenever vintage and hold periods get longer and longer, there becomes less certainty around those theses. Just like if you buy a house in a neighborhood, you know in 3 to 5 years that neighborhood's probably still going to be good. Much harder to project what's going to happen in 15, 20 years. And similarly, with a lot of these companies bought a long time ago. What a fascinating time in the markets. Matt, anything else you wanted to share with us today before we wrap up?
Yeah, I would just say, as we're working through this regime change that Scott, I feel like we've been talking about for at least a year, maybe almost 2 years. It will take time to work out. There are challenges, but those challenges create opportunities, right? So there are definitely opportunities for investors, for operators. Might require some short-term pain of exiting certain companies or businesses or segments of the market, but as the regime evolves into this new sort of positive real interest rate environment that looks very much like other cycles did. Again, we've talked about this before, but the 15 or so years between the global financial crisis and the pandemic, where interest rates were very low, that was the aberration. Now we're working back towards normalcy. And as we work through this transition, there will be a lot of really great opportunities for savvy investors and savvy operators.
We sure hope so. Take one moment and tell us a little bit about Elliott Davis. You moved to Elliott Davis recently this spring. Talk a little bit about Elliott Davis for a second.
Yeah, happy to. So, Elliott Davis is another large public accounting, consulting, audit, tax advisory firm. And I think we're very well situated in sort of core middle market to lower middle market, a very nimble operating model that allows us to be a very astute kind of core advisor to growing private equity backed businesses, right? Really be sort of very aligned in terms of nimble operating models, growth projections, outlooks, and it's just we're very well positioned to be that advisor. That's how the firm is built, and yeah, it's been a great transition. It's a great firm.
Thank you very much, Matt. Always great to visit with you again. Matt Wolf, Elliott Davis, thank you so much for joining us on the Becker Private Equity and Business Podcast. Thank you.
Thank you.